Okay, so Bank of Hawaii just dropped its fourth quarter 2025 earnings, and let me tell you, the market's reaction was pretty electric. We're going to break down exactly what's got everyone so excited.
And when I say electric, I'm not kidding. Look at this number, a pop of over 6%. That's how the stock closed on January 26th. So yeah, investors clearly liked what they heard. The big question is, what did Bank of Hawaii actually deliver to spark this kind of rally?
While the main story here is a really decisive beat on both revenue and earnings. Bank of Hawaii didn't just barely clear the bar. They pretty much soared right over it. Let's just look at the numbers. Earnings per share hit $1.39. That's a full 13 cents above what analysts were expecting. And revenue also came in super strong, beating expectations by almost $5 million. It's a solid performance, for sure, but the real story is in how they pulled it off.
And that brings us to the engine room of any bank. It's net interest margin, or NIM as we call it. This is absolutely the crucial metric that explains the strength in BOH's quarter, and it's why the outlook looks so good.
Just look at this trend. This wasn't a one-time thing. We're talking about the 7th straight quarter that Bank of Hawaii has grown its net interest margin. It expanded by 15 basis points this quarter alone, up to 2.61%. This kind of consistency is exactly what gets investors excited.
So, the big question is, how did they do it? I mean, in a pretty tough environment for a lot of regional banks, what's Bank of Hawaii's secret sauce for growing its core profitability, quarter after quarter?
Well, it really all comes down to what management calls the balance sheet remix. It's actually pretty smart. They're swapping out older, lower-yielding assets for new, much more profitable ones. At the same time, they've actually grown their cheapest source of money. Those are non-interest-bearing deposits. And then, the cherry on top, they've kept a really tight lid on expenses.
Now you're probably thinking, okay, did they just take on a ton of risk to get this growth? And the answer, straight from the CEO himself, is a very clear no. The bank's credit quality is, and I'm quoting here, pristine. So this isn't growth at all costs. This is just disciplined, smart execution.
So, that's the story of the last quarter. That's what happened. But what has the market really buzzing is what comes next. And from the sounds of it, management's guidance is hinting that this is really just the beginning.
Okay, this is the number you need to watch. Management is actually guiding for their net interest margin to get close to 2.9% by the end of 2026. If they hit that, it means that amazing 7-quarter expansion streak we just saw, well, it's still got a lot of room to run.
And here's where they're really putting their money where their mouth is. After buying back $5 million in shares last quarter, they're signaling a major step up. The new plan is to buy back $15 to $20 million worth of stock every single quarter going forward.
So what does a signal like that really mean? A buyback of this size is just a massive vote of confidence from the people running the company. It tells investors two things, loud and clear. One, they believe their earnings growth is going to continue. And two, they think their own stock is a really smart investment right now. All right, so with a strong quarter in the rearview mirror and some really positive guidance ahead, what should investors be watching for next? Let's break down our take on it.
Okay, let's just get right to it. So here's the bottom line from our perspective. We fully expect another earnings beat next quarter. That NIM momentum is just going to keep going, and we think their cost discipline is going to hold. For the stock itself, we think there's more room to run. Honestly, the full potential of this margin story doesn't seem to be fully priced in yet, and those huge buybacks are going to provide a really nice cushion for the stock. All of this leads us to an outperform rating. The path to higher profits is clear, and the company is rewarding its shareholders along the way. That is a very powerful combination.
And of course, just a quick reminder, this analysis is for informational purposes only, and it is not financial advice.